Hi friends, how are you? By blessings of the God, you are doing well. This is Dr. A B JENA, Senior Assistant Professor, PG Department of Business Management, Fakirmoni University, Vyasabhyar, Balasur, Odisha. Once again, I am welcoming to all of you to Dr. A B JENA classes, and today we are going to discuss the very useful and interesting the topic. Let's say that is the working capital. What is the meaning of working capital? And what are the sources of working capital? So, without delay, we'll start our discussion. So, I am 100% hopeful you will enjoy in this video. Definitely, you will get the more idea and the clarification with regard to the various sources of working capital and different the terms. And so these terms are from time to time you will get in the exemption as well as in the competitive exemptions. Okay, so dear friends, without delay we will start our discussion. So before starting the discussion, kindly you take the screenshot. So what is the meaning of working capital? So working capital refers to the gross working capital. Working capital refers to the gross working capital which represent the amount of funds invested in where the current assets. So where it will be invested in the current assets. Once again I am repeating, the working capital refers to the gross working capital and represents the amount of funds or the money or the finance invested in current assets. Okay, dear friends, I have already posted 3 videos. What is the meaning of working capital, the concept of working capital, need or significance or importance of working capital, as well as so what is the basic difference between the fixed capital and the working capital, as well as another video I have already posted what are the different types of working capital. So definitely I will request to all of you, okay, kindly go through the previous videos and you will get more and more idea. Okay, so dear friends, so we have already covered the working capital. Now we'll discuss what are the different sources of working capital. I mean, a business organization or an enterprise or a firm or a company will get the working capital from where. So it's a vital, very vital, because without or the right amount of the working capital, entire organization will be or the organization will suffer. So that's why working capital is most as well as the vital so far as its growth, development and the other objectives of a firm or the business organization. So there should be the adequate working capital. Why adequate working capital? The production process will not be affected, as well as other the day-to-day expenses of the business will not influence or will not affect the growth and development, as well as the short-term financial requirements of a firm or of a business organization or of a company. Okay, so normally the firm, so the firm will get the working capital from 2 sources. Okay, so first one is that is the permanent, or it's known as that is the fixed working capital, and the second one is the variable or the temporary working capital. So that's why, yes, so the permanent and the fixed working capital, which we have already discussed in the previous video, kindly go through this. And here a firm, okay, must maintain the fixed working capital out of from where the fixed capital sources. So these are the fixed capital sources. So definitely a firm or a business will depend, or the business will get the fixed portion of working capital out of or from the fixed capital sources. And what are the permanent or fixed working capital? The company will issue the shares, company or the business will issue the debenture. Okay, again company will issue the public deposits, as well as so a return earnings. So what is this return earnings? So internal sources of finance, and we'll discuss in later. Then the company will raise or will get the fund or working capital Okay, from the FIG. FIG stands for the financial institution. Okay, come to the temporary or the variable working capital, and from where a firm or business or company will get, okay, company will get from the short-term sources, okay, of short-term sources of capital. So these are the firm will get the temporary or variable working capital from the indigenous banker, okay, trade credit, installment credit, advances, factoring, okay, commercial paper, then deferred incomes, then accrued expenses, then okay, commercial banks and the letter of credit. So we will discuss one by one. So first, dear friends, we will discuss the permanent or the fixed working capital. So first one is that is the share. By issue of the shares, then the company will get the capital. Yes, I have already posted the separate video. What is the meaning of shares and what are the different types of shares and what is the basic difference between the equity shares and the preference shares and what are the different types of preference shares. Okay, so I will I'm requesting to all of you kindly go through the previous videos. Okay, I have already posted. Yes, so normally the shares are normally divided in two parts: equity shares and the preference shares. And equity shareholders are the real owner of the company, and they will not get the fixed rate of dividend, okay, on the basis of or the available of the profit. So they will get the dividend. Whereas the preference shareholders, so they will get what is this? The fixed rate of dividend. Okay. But the equity shareholder will not get the fixed rate of dividend. Come to the second one. It's the company or the firm will issue the debenture. What is the meaning of a debenture? It is debenture. It is an acknowledgement of debt. So I have already posted one separate video. What is the meaning of a debenture and what are the different types of debentures, as well as what is the basic difference between the shares and the debenture. Okay, so kindly go through the previous video, you will get the more idea. Okay, so debenture holders, so they will get the what is this? The fixed rate of interest. They will get what? Fixed rate of debenture holder or bond holder, okay, or security holder. They will get what? The fixed rate of interest, irrespective of or whatever the profit or earning capacity of the business. Okay, come to the third one. What is the meaning of public deposits? So public deposits, what is this? It is the unsecured deposits or the money invited by companies from public mainly to finance to meet their short-term as well as the long-term financial requirements. Okay, so public deposits, a company will issue the public deposits, I mean the okay, through or the documents or the certificates in order to meet the short-term as well as the long-term financial requirements. Okay, then for next one is that is the written earnings. Written earnings, okay, so written earnings are written earnings. Also always definitely you will get the question what is the, or everywhere you will get the question what is the meaning of written earnings. Written earnings, okay. So question is here, whatever the profit will be available, okay, whatever the profit will be available after paying, okay, so here the amount of the profit of a company that, okay, has left after paying all direct and indirect cost or the expenses, income taxes, okay, or paying the interest to the debenture holder, here also the interest, then dividend to the preference shareholder. So whatever, so here let's take an example. After paying the both the direct and indirect cost or expenses, income taxes and dividend to the preference shareholder, let's take an example is 100 crores. Now the 100 crores is a 100 crore is available. Okay, so here the important decisions will be taken by the company that how much profit, okay, will be given to the equity shareholder in the form of a dividend and how much will be retained. Let's take an example. It was decided that, okay, so 50 crores will be Okay, 50 crores will be given as a dividend to the equity shareholder, and the remaining, so 100 crores minus 50 crores. So remaining is how much? Rupees 50 crores. So 50 crores is what is this? It's the retained earnings to a firm or to a company, and the retained earnings is a, okay, very useful and internal sources of finance, and the retained earnings will be again reinvested into the business for its the more growth, development, modernization, expansion, or the company will acquire the another company like this. Okay, for this purpose the retained earnings will be used. So that's why the retained earnings are, okay, very vital to the company. So dear friends, I am hopeful that by citing the suitable example now you are clear. Okay, so don't forget. Yes, last but not the least, it's that is the loan from the financial institution. AFIs means the financial institutions. The financial institutions, so they are the vital component, or they are playing in the vital or the major role, okay, in Indian financial system, and normally so they are providing the loans and advances to the business houses or the corporate houses. So these are the better sources, or the loans from the financial institutions are the better sources of finance to a firm or a company, okay, to meet what? The long term as well as the, okay, the medium term financial requirements, as well as the, okay, to meet the working capital requirements. So dear friends, now you are clear. So these are the permanent or fixed sources of okay, working capital. Again I am repeating: issue of shares, issue of debenture, public deposits, return earnings, and the loan from the financial institution. So now we will discuss one by. So what is the meaning of okay, or the how a firm or company will raise the short-term finance, I mean the temporary or variable working capital from these sources. Okay, so we will discuss one by one. Now we will discuss the last part of this discussion, and the last part of the discussion is what are the important sources for the temporary or the variable working capital. Okay, dear friends, so before discussing one by one, kindly you take the screenshot. Okay, so these are the sources of temporary or the variable working capital. So I have written 10 the sources for the variable or the temporary working capital. So we will discuss one by one. So first one is that is the indigenous banker. So sometimes what happens, a firm borrows the money from the private money lenders to meet the working capital requirements or the need. Yes, sometimes a firm will borrow or takes the loans from the private money lenders. So private money lenders normally, so they usually charge a high rate of interest, but right now it's the indigenous banker concept is not popular. Okay, after the vibrating or that is the reform process of Indian banking sector. Okay, second one is that is the trade credit. So trade credit, what is this? So it is an arrangement to buy the goods or services from the suppliers without making immediate cash or check payment. So here what a firm does, so firm will purchase the raw materials and other the spare parts and other items, so from the supplier on credit basis without making the payment immediately, either the cash or the check. So it's also the cheap sources of the finance for the variable or the temporary working capital. Next one is that is the installment credit. Installment credit here, yes, so it's the another sources of the various sources of finance to the variable working capital. The credit is granted on condition of its repayment at a regular intervals or the installments over a specified period of time till the, okay, until the or the till payment in the full. So it's in. Next one is that is the advances. So here what happens, if firm gets the advances from its customer against the order. Here what happens, so normally if the working capital cycle is that is the longer period, or the production cycle it's the longer period, so in this situation a firm gets the advances from its regular customer against the order. Okay, so it's the another sources of temporary or working capital. Okay, the finance. So next one is that is the factoring. So factoring is also very important and the vital. Okay, not only from the exemption point of view but also from the competitive point of view. Okay, so in a future we will prepare or we will discuss or I will post the separate video on the factoring. What are the processes or and other aspects of factoring. Okay, so factoring is what is this? It is a financial agreement. Okay, factoring it's a financial agreement between B/W between the factor and the client. So who is the factor and who is the client? So they are the parties. I mean, the factor and the client. So they are so there will be a financial agreement between the factor and the client in which the firm. So here firm means the client. So your firm will be the client and gets the advances in return of receivables. So it's accounts receivables or the bills receivables. So receivables means it's the accounts receivables or the bills receivable from the financial institution. So financial institution, who is the financial institution? The factor. The financial institution, it may be the banks and commercial banks and other financial institutions. So factoring is nothing but what is this? Just you will sell your bills receivable to the financial institutions or the bank, and the bank will purchase your accounts receivables or the bills receivable, and instantly, normally what is this? 80% of the invoices or the accounts receivable or bills receivables amount will be given by a bank or the financial institution to you. So in this situation, the factor, I mean the banks or the financial institution will deduct some amount from the invoice, and whatever the deduction amount, it's the income, or it's the revenue to the factor or the commercial banks. Okay, dear friends, now you are clear. Okay, so again I am repeating, factoring is a financial agreement between the factor and the client in which the firm, who is the firm? Here the client gets the advances in return of a receivable means accounts receivables or bills receivable from a financial institution. The financial institution known as the factor. Okay, next one is that is the commercial paper. Commercial paper, this term is also the very vital. So you have to remember it. Commercial paper. What is this? Commercial paper is an unsecured promissory notes issued by a firm or company or business organization to raise the certain funds. Okay, the commercial paper. So this is the money market instruments. In separate video we will discuss in detail. So by issuing the commercial paper, you can get, or your business or your firm can get the certain the funds to meet the certain financial requirements. Next one is that is the deferred incomes. What is this deferred income? So these are the incomes received in advance. So your firm or you will receive the income in advance, so before supplying the goods. Why? So nowadays, suppose your firm reputation goodwill is more in the market, or your firm's product is so it's a market demand is more. In this situation, definitely, so there will be the heavy demand or more demand from the customer side in favor of your product. So it's that is the deferred income. So deferred income, it's that is the so another sources of that is the fund or the finance for the temporary or the variable working capital. So deferred income, that is the liability. Current liabilities. Next one is that is the accrued expenses. What is this accrued expenses? The expenses which have been incurred but not yet due. And hence not yet paid also. So it's also the another sources of fund or the finance towards the temporary or the variable working capital. So next one is that is the letter of credit. Letter of credit. What is this letter of credit? Letter of credit. It's also that is the important concept. Always you will get the question. Not only in your exemption but also in competitive exemption. Okay, so letter of credit, what is this? Letter of credit is a document. Letter of credit is a document from a bank or financial institution on buyers, okay, on buyer's behalf, that ensures the payment to the seller. So not only the letter of credits, it's a normally it's a very vital and useful in the case of a foreign trade or a import and export trade. So simply what is this letter of credit is nothing but it's a guarantee is given by a commercial bank to the customers, okay, when the invoice or the bills will be presented, the bank will make the payment. Bank will make the payment. Let's take an example. Suppose A is a customer, B is the seller, or A is an importer, B is an exporter. Okay, so there will be the agreement. So A will purchase the goods from the B, and so before dispatching, delivering the goods by B, so B will want what is this regarding the payment. So here what will be happened? Yes, so A will make the agreement with his or her bank. Let's take an example, that is the SBI. So SBI, so I am not promoting the SBI, just for example I am citing, okay, or I am taking the SBI, then the SBI will make the agreement with the SBI. So when, okay, B will present the bills or the invoice, the SBI will make the payment to the B's bank. Okay, so A is an Indian, okay, A is an Indian importer, B, let's take an example, B is an exporter from Australia, okay, from Australia. So here, so A's bank or importer's bank is SBI will make the payment to the B's bank. So B's bank is let's take an example, that is the Bank of Australia. Let's take an example, that is the Bank of Australia. So after getting the confirmation of the payment, then the B means exporter will send the goods to A. So it's the mechanism. So detail we will discuss what is the letter of credit and what are the different types of letter of credit in another video or separate video. We will discuss in detail by citing the suitable examples. Okay, dear friends, now you are clear. The letter of credit, again I am repeating, letter of credit, it is a document from a bank, okay, by citing suitable examples, or the financial institution on buyer's behalf, that the buyer's bank, I mean the SBI, will ensure the payment to the seller. Who is the seller here? The B. Okay, so last but not the least, in the important sources of finance or the fund towards the temporary or the variable working capital, it's the commercial banks. Okay, commercial banks, so now they are playing a vital role in India. Okay, and so commercial banks, CB, commercial banks are the most important sources to meet the working capital requirements of a firm. So normally the commercial banks will provide, so these are the the financial services to the firm or to the customer. So first one is that is the loans. So commercial banks provide the short-term loans, short-term loans to a firm to up to 1 year. So here up to 1 year to meet the working capital needs or the working capital requirements. So second one is so bank also provide what is this, that is the cash credit to the customer or to a firm. So cash credit, it's known as what is this in short form, CC, or it's also known as working capital loan or loans, working capital loans. So cash credit, CC, is a short term loans provided by a commercial bank to a firm to meet the working capital requirements. So working capital requirements against some tangible assets or guarantee. Okay, so it's that is the cash credit. Cash credit, once again I am repeating, it's the vital concept, important concept. It is, so cash credit is a short-term loans provided by a commercial bank to a firm or to a customer to meet the working capital requirements against some tangible assets or the guarantee. So here the tangible assets or the guarantee will be given as the security or the mortgage. Then the commercial banks will provide the cash credit. Okay. Then here the bank will also charge the interest. So next one is it's the overdraft. It's in short form. It's known as that is OD. OD. What is this? So it is an agreement. So overdraft, it is an agreement between a commercial bank, CB, commercial banks and the account holder, where an account holder can withdraw more amount, the balance amount up to a certain limit. Let's take an example. Suppose you are an account holder of a bank. Suppose in your account, so there are 50,000. Okay. So what is the balance amount is how much? It's that is the 50,000. You can only draw or withdraw from the bank up to 50,000, but under this agreement, you can withdraw or you can draw more than the deposited amount. So your account's balance is how much? 50,000. So here in this situation you can draw 80,000 or it may be 1 lakh. Okay, as per the agreement. So here also the bank will charge the interest. More interest as compared to the cash credit. So cash credit is normally given for the short period. Very that is the short period. Last but not the least, so bank also, commercial banks, so they will also purchase the bills. Bills means here that is the invoice, or you can say that is the so that is the bills of exchange. You can say also the bills of exchange. What is this? It is also an important sources of finance or the fund where a commercial bank lends a firm without any collateral security. Without any collateral security. Here, what is this? Let's take very simple. Here, the commercial bank, the discounting the bills means or bills discounts means it's nothing but what is this? Simply you will sell your bills of exchange, or bill to the bank, or the bank will purchase your bills. After getting this, then the bank will provide the or the money to you. So here also the bank will also charge some interest, or will deduct some amount. So that amount will be treated as that is the interest. So these are all about today's discussion. So dear friends, so once again thanks a lot to all of you. I am hopeful that you have learned a lot with regard to the sources of working capital. And so I will request to all of you, kindly you subscribe it, kindly you forward it, kindly you share it. So I am waiting for your valuable comments for the next video. So tab tak ke liye bye. Once again thanks a lot to all of you.